Hello everyone, and welcome to today's webinar session being hosted by the CA Business School in partnership with Training and Advisory Services. Our topic for discussion today is on demystifying hyperinflation reporting in Zimbabwe. And according to the latest statistics from ZimStats, our Zimbabwe year-on-year inflation as of 31 March 2020 has jumped to 676%. And I believe for most of us who experienced the pre-dollarization era, we never thought we'd get back here again. My name is Elliot Honenika, Managing Director at CAA, and I'll be your host today. And I'll be assisted by Jonathan Samapetere as my co-host. And we hope the session will be both informative and engaging. At this stage, I would want to welcome our panelists. I've got Anne Sudaka, CASA, then IFRIS expert, as well as the Group CEO of Dossier Group. In other circles, he is also known as Mr. IFRS. Anis, welcome.
Thank you, Elliot.
Okay, I also have Raymond Chamboko, Chartered Accountant in Zimbabwe, who is an IFRIS expert, as well as the Director of W Consulting, a leading corporate reporting, advisor, human resource development, and e-learning solutions business with offices in South Africa, Mauritius, and the United Kingdom. Raymond, welcome.
Thank you, Elliot.
Okay, then we also got Simbise Musa, who's an investment professional and currently responsible for managing an analysis of both both listed and private equity at the National Social Security Authority. Simbise is also a judge and chairperson of the Financial Gazette on an Old Mutual Top Company Survey. Simbise, welcome and thank you for joining us.
Hello and good morning, everybody.
Thank you. Also joining us is Webster Sigauke, a chartered accountant, IFRIS expert and deputy managing director at CAA. Webster currently lectures financial reporting for chartered accountant students. Welcome, Webster, welcome and thank you for joining us.
Thank you very much, Elliot. Good morning, everybody.
Our last panelist, Axel Mafunde Mata, a chartered accountant, who is also an IFRIS expert and technical manager at Training and Advisory Services. Axel has been actively assisting a diverse portfolio of clients with hyperinflation accounting as well as functional currency issues in Zimbabwe. Axel, welcome and thank you for joining us.
Thank you, Elliot. Good morning, everyone.
Okay, so before we start, some housekeeping issues. So during this webinar session, we would love to hear from you. So please do feel free to make use of the Q&A platform, and we'll try as much as possible to have our panelists respond to all your questions. And also we'll be running a few polls to get your views as we go along. So please do also participate in this. So our first poll that we want to run is to get a sense on who has joined us in today's session, so that we can allow our panelists to, as much as possible, customize their presentations to the audience that have joined us. So if you can please take a few minutes to participate in the poll that I'm going to launch to your screen right now. So I'm going to give you a few minutes to participate in the poll. Okay, I hope I managed to capture most of the professions for most of the people. If you can please just quickly vote. Okay, I'll allow a few more seconds for the voting for those who just joined us. Okay, I'm going to end the poll now and broadcast the results for us to see. So interesting, I think most of the audience have got accountants, specifically the financial statement preparers. I also see we've got investment analysts, a couple of audit committee members, the regulators, as well as others who have joined us. Thank you for taking your time to join us in this session, and we hope that you are going to find it both informative and interesting. And to those who have just joined us, Welcome to our webinar session on hyperinflation reporting. My name is Elliot Woninyika, and joining us today are our panelists, Anne Sudaka, Raymond Chamboko, Simbiso Musa, Webster Sigauke, and Axel Mafundemat. And please note a recorded version of the webinar and presenter material is going to be made available to you who host this session. We are also live streaming the webinar session on our Chartered Accountants Academy Facebook page. So without further ado, we are now going to go straight into the issue that brought us today, which is discussion around hyperinflation accounting. And my first panelist to share is going to be Anne Sudaka. So at the moment, I'm going to be sharing screen with Anne's presentation. Anne, over to you.
Anne, unmute yourself.
Okay. Good morning, everyone. Thank you so much. Thank you, Elliot. Can you hear me properly? Wonderful. Thank you so much. I think this issue, which we are talking about today, regarding hyperinflation, I think it's an opportune time to have this discussion, because we are seeing financial statements that are looking a little bit different from what we are used to. So it would only be appropriate to be able to give some highlights in terms of why are the financial statements looking as they are today, and also helping the investing public and financial analysts out there in terms of what it means and how inflation has affected us. I would probably take us back to I would take us back to 2016. Right. I'll take us back to 2016, and I've got that small diagram, there, which probably explains to us what caused hyperinflation in Zimbabwe. So the first thing, I'll give it in a summary point of view, the first thing that happened to Zimbabwe was the change in functional currency, right? So when you look at the diagram there of the things that happened or the events that happened from 2009, the biggest issues which causes us to find where we are started in 2015 when we introduced the bond coins then, and then in 2016 October when the bond notes were then introduced. I think by 2016 end of year, we started seeing what was referred to as a premium on prices. Now, the biggest question one has to ask themselves, and which is still a very big question today, is when did we get to start using our local currency? So what you then find is when we started seeing a premium, it referred that there was a difference between the US dollar and the other currency that was operating.
Anesu?
Hi, Elliot.
Yes, if you can please put presenter mode on the presentation.
Oh, okay, thank you.
Can you put slideshow? Yes, thank you.
Right. Okay. Right. So I was saying we need to note. Right. We need to note that there was currency which was operating, which is the US dollar, right? And on the US dollar currency that was operating, we started seeing the premium. The premium was mostly as a result of the use of the bond notes and the bond coins and the absence of the US dollar. So from that perspective, price started skyrocketing. And we then see the introduction in October 2018, the introduction or the separation of accounts, and eventually SI 33 coming in February 2019. Transposed to that, as you see on the bottom, is the inflation diagram. To say by 2019 January, we were sitting at 98% inflation, and which means the inflation had started rising way earlier. One may actually ask and say, the inflation measured under that diagram, had we started measuring inflation by accepting a new currency as of 2016, when the premium was moving, would we have the same figure? So that is still a very big issue which we are sitting with, and no wonder why you find that most accounts that we are sitting on or that have been audited have an adverse opinion. It all emanates from this. So what causes hyperinflation, or what causes the need to prepare hyperinflation accounting, is when inflation exceeds cumulatively 100%. Normally they say over 3 years, but the cumulative for Zimbabwe was achieved way earlier than 3 years. So that's one of the biggest reasons that we find ourselves in terms of finding ourselves in hyperinflation. I would say when this started happening, you'd find that the population started triple pricing. When I say triple pricing, we have got an eco cash price, you had RTGS price, you had a cash price, and probably one could say a US dollar price as well, a bond cash price as well, but normally sometimes refers as the cash price. So if we move down, you would also see, okay, my slide is not moving, but what then also happened is that there are certain indicators and behavioral issues that you would see in the market. I will not dwell on this much because it will be dealt with in the next presentation, but we found ourselves in a place where we couldn't, from 2018, end of 2018, 2019, we couldn't price, we couldn't conserve value in Zim dollars or RTGS or bond as people refer to it. Now, the key question that a preparer, an investor, a regulator would start asking is, can I rely on financial statements? Does the information that comes from these accounts make sense? And in that case, we've got to have to go back and say, what is it that financial statements should have versus financial statements in the state of hyperinflation? So I'll quickly take you through to the requirement from IS 29. It says that in a hyperinflationary environment, when financial statements are prepared using a historical figures, those financial statements will be misleading. Rather, financial statements should be inflation adjusted, and inflation adjusted accounts would bring financial statements and figures to the state or current values at a reporting date. And these are the only financial statements that make sense. So this then forms the basis for which you would find the set of financial statements that are now coming in almost duplicates, where you've got historical and inflation adjustments. This is to try and find or give relevance to financial statements. I would also hasten to point out that the financial statements, or this work, there was a lot of work that was done regarding this from the regulators, PAB, the ZSE, ICAS, Zimbabwe as a whole, the ministry. This started on the impact of hyperinflation, or the impact of functional currency. When we were saying, is the currency changed? At that point, some thought that it was only hyperinflation. But unfortunately, it couldn't be hyperinflation because we needed to discover which currency first was under hyperinflation. When we discovered the currency, then we can say this currency. So as of 2018, when this started happening and inflation started changing, we could not say US dollar was under hyperinflation. So a lot of work was done to determine currency first in terms of the currency that was operating in Zimbabwe. Then the next process was then to say, is this currency under hyperinflation? And I'm sure as the diagram you saw first, that by January we were already at 98%. It then indicated then that we had a currency and this currency was under hyperinflation. I'll stop there for picking, but just to highlight again the key points, the inflation, hyperinflation that we find ourselves in was caused by change in currency, which happened sometime between 2016 and early 2019. The next is then the lack of confidence that caused the skyrocketing of prices. And that were the biggest drivers of hyperinflation. And we then find that our financial statements couldn't be relevant if we were to report historical, and we needed a method, a way of presenting or recording financial statements without, which makes relevance to the investors, the analysts, and everybody. Thank you. Elliot, I give back to you.
All right, Anesu, thank you very much for setting the scene in terms of what we are going to be discussing here. And for those who have just joined us, I can see our participants and the numbers are growing. Welcome to our webinar on hyperinflation reporting. And also notice that the Q&As have started to come through. So what we will do, some of the questions relate to the topics that are going to come later on. So I'll address the questions when we come to them. But I'll address the question which was raised around whether this webinar session accounts for CPD hours. So yes, it does. So the webinar is going to accrue 2 hours CPD for those who may need to post CPD hours with their membership bodies. Thank you. So right now, allow me to go to my next presenter, Simbiso Musa, who's going to give us a perspective from an analyst or user of financial statements to say when they look at these figures, what exactly do they expect to find? So Simbiso, over to you.
Okay, thank you, Elliot. All right. Oh, yeah. Okay. Sorry about that. Thank you, Anesu, for the introduction. I'll dive straight into my presentation. I think my slides are not moving. Okay, as outlined, yeah, it's okay now, as outlined before. I think for the purposes of this discussion, I'll start by just briefing on the role of an analyst with regards to financial information. Is basically analysis and interpretation of the information, which then leads to valuation of the investment asset, and then at the end of the day, you then place an investment recommendation based on this valuation and analysis. So pretty much the work is to dissect, disassemble, and reassemble the financials to arrive at recommendations. Accountants pretty much pack the financial information, we unpack it, and it's all about the story behind the numbers. So with the advent of hyperinflation, I think significant concerns have been raised with regards to the measurement systems. Despite one of them being the regulated and stipulated measurement, we find them competing with regards to usefulness. On one hand, you've got historical cost, which impairs comparability and ignores non-monetary gains. And then on the other hand, you've got inflation adjusted, which uses CPI. And we all know there is considerable, there's a debate on with regards to the accuracy of the calculation of the CPI. And I think largely one of the contentious issues is the basket of goods being used in the calculation of the CPI, a true reflection to what exactly is on the ground. I think given the background of these concerns, it then presents challenges in unpacking the financials in such an environment. Analysts need to look at the statement of comprehensive income, assessing sustainability and assessing growth of the company, assessing quality of earnings and key drivers. But the challenge is evaluating trajectory. I think you see in the next slide what exactly I mean by evaluating trajectory. Is the company growing or is the company shrinking? So we've got confusion over which method shows us the actual direction where the company is going. Going on to the cash flows, we assess cash flows from continuing operations and its ability to meet obligations. But the challenge is meaningfulness of these cash flows. We obviously know that cash received in January 2020 is different from cash, that's ZWL, cash received in May 2020. But is that being shown in the financial statements? Is that being shown? Maybe, maybe not. And then statement of financial position, analysts need to assess capital structure as well as asset quality, but that is also challenged by that assessment is also challenged by revaluations, despite a lot of revaluations being done by independent bodies, but there's no formal and standardized way. So is it a true picture or is it a reflection of what the business is worth, that revaluation? So after assessing all these elements, it then leads us to valuation of the company. The primary focus being on future earnings generation and growth. Analysts need to assess whether the direction of future earnings or the direction of growth, is it going up, is it going down? But the challenge now is that quality of our elements are compromised. And then the other thing fighting that as well is delays in publications, making valuations less relevant. For example, on the ZSE, I think half of the ZSE listed companies, they have not produced their 31 December 2019 financials. They were initially due at 31st of March, and then it was pushed to 30th of April. And now we don't even know what the exact deadline is anymore. And that really affects the quality of valuation, because if accounts are released 6 months after the date of the cutoff date, it distorts everything, and especially in a hyperinflationary environment, a lot of events would have happened. A lot of the operating landscape would have significantly changed. So their meaningfulness, if they are released late, is really a cause for concern. So at the end of the day, there's risk that investors are actually making uninformed decisions because we don't have the basis for making decisions. We're grateful for quarterly updates, but they don't include numbers. So at the end of the day, we're still pretty much concerned as to the timeliness of release of financials. So I think accountants would really have to help us there to balance the act. So I think I'll dive straight into an example to support what I was talking about with regards to challenges. This is an excerpt from Tenor Holdings results. It's a publicly listed companies, and they published their results, I think, a month ago. And it's showing inflation adjusted accounts as well as historic adjusted accounts. So I'll just take you to a few elements here. We've got revenue. Under inflation adjusted, revenue actually declined from 259 to 31 million by 11%. And under historic adjusted accounts, revenue grew by 218% from 32 million to 102 million. And then you go to gain on net monetary position. Under inflation adjusted, we've got a 72 million gain, and under historic, there's nothing. And then there's profit for the year. Under inflation adjusted, we've got 96 million, and under historic adjustment, we've got 72 million. So the issue here is the discrepancy on the results, which shows divergency in the measurement systems. And it's really a cause for concern for analysts. And I think it should be as well for accountants. And I believe there should be maybe discussions or efforts to actually make these methods diverge, because after all, we're talking about the same entity. So it causes a bit of confusion as to the issue of direction, trajectory that I was talking about. Another set is saying revenue went down, and then another set is saying revenue went up, despite the issue of lack of comparability in historic adjusted accounts that I talked about. But I think going to the next slide, where we have a statement of cash flows, I think cash flows, they actually, we use them to check for quality of earnings, and there should be a near reconciliation of our profits and like profits and cash flow, there should be a near reconciliation, again, to assess quality of the earnings. But again, this time, after the big figures that we saw at the bottom line, we see cash flows of 1 million against profits of, I think, 90 million and 2.2 million here under historical, which also goes to show about issues of quality of earnings and also divergency of views as well, divergency of views between these two methods. I think this all then, I can then wrap up what exactly analysts expect in such an environment and delivery from financials. We expect timeless delivery of financials. For information to be useful, it has to be delivered timelessly so that it can be utilized and valuations can be done accurately. We expect comparability. We need to see the trajectory, whether it's of growth, whether it's of sustainability. We need to see the direction where the company is going. We don't need to be confused as to, is the company growing or is it shrinking? It has to come out. And then we talk of completeness and comprehensiveness. I think this speaks more to disclosures. If an inflation adjusted factor has been used, we need to understand how it was arrived at. So you'd find most financials, they come out without that data. They just state that the inflation adjusted factor was 1 or it was 2, but we need to see the background how we arrived at that factor. So there is need to invest in proper disclosures, comprehensive disclosures that actually empower the analyst or the user of financial statements to make an informed and near accurate decision. Then I think lastly, reliability and consistency. On reliability, I think you're talking about, does the position presented faithfully represent what it's supposed to represent? So you'd find most companies, even loss-making companies in a non-inflationary environment, when we get to inflationary environment, they report everyone is profitable, pretty much. But I think there is something lacking there with regards to maybe fundamental reporting, because as soon as we get out of the non-inflationary environment, they start being loss-making again. So I think those elements, they need to be also come out and properly disclosed as well. I think the last would be consistency with regards to financial methods, what you call it, the measurement methods, accounting methods used consistency. You'd see that sometimes when we get to hyperinflationary companies, they change the way they treat depreciation and stuff like that. So I think consistency is also another important factor that we expect. I think that pretty much sums up my presentation. Over to you, Elliot.
So thank you very much for that insightful perspective. I'm sure as accountants, when they're preparing these financial statements, they with the users in mind. So from Simbiso's presentation, the main thing that I picked out was, if you look at hyperinflation accounts versus historical financial statements, they tend to communicate a conflicting story. So how does this happen, and how should analysts then make use of these financial statements? And I hope if it's expert that we've included in our panelists are going to delve into these issues deeper to explain how to interpret these numbers, how these numbers are derived and generated. So once again, thank you very much for that presentation. And for those who are in the Q&A platform, yes, we are taking note of your questions, and we'll be bringing them to the panelists as we go along. So don't worry, we are not ignoring you. We are seeing the questions. So we'll move on with our presentations. Now we're getting into the technical issues, starting with the regulatory requirements around why we need to prepare hyperinflated financial statements. And to take this session, I've got Webster Sigauke. Webster, over to you.
Thank you very much, Elliot. Just a moment to check if I'm able to move my slides. Okay, great. Good morning, everyone, once again. So I would like to pick up from the areas which were raised, starting from where Anis left off, in terms of the environment had become quite unstable, and the change in functional currency caused a lot of people to then start questioning on the new currency which had been brought through. And I think as we go back to the presentation from Simbiso, it's quite sensible for investors to then raise questions in terms of understandability and decision-making from the figures which have been presented by accountants. So when you look back at our regulatory environment, we've got the PAB being the regulatory board set in Zimbabwe to be able to issue standards. Now, the PAB first gave a paper that they issued out in terms of the change from functional currency, moving from the US dollar into the Zimbabwe dollar sometime in February 2019. But there has been mounting pressure then ever since by looking at the inflationary figures which are coming through in that new currency which was brought through. I think when you look at the slides that I'm currently sharing at the moment, you see that at the point of issuing out their guidance in February, the inflation figures were sitting at around 59.39%. But within 3 months, we'd already reached a section of where we were sitting at around 175%, which was sometime in May. So within 3 to 4 months, we had inflation which had almost tripled, in fact. Now, what people started inquiring on was, number one, how can we use the accounts? We saw a lot of investors questioning in the ZSE, giving a reprieve to extend the publishing of interim results because they could not be used in historical form. And then we also had a lot of subsidiaries in Zimbabwe, which had parents which are outside Zimbabwe. So when those parent entities get the figures from Zimbabwean subsidiaries, the figures just didn't make sense. So that pushed a lot of members of PAB to go back to PAB and say, yes, we are now in this new functional currency, which is the Zim dollar. But now, what do we do with these figures which do not make sense? So PAB went on to make an assessment, and they did stakeholder engagements to try and assess the nature of the economy in terms of if we are in a hyperinflationary environment. And part of the things that they looked at is the International Practice Task Force opinion. Sometime in 2018, the International Practice Task Force is a committee which sits and assesses countries which are almost in hyperinflation or which are already in hyperinflation. And already by June 2018, they'd already put Zimbabwe as one of the countries which were projected to have an inflation, cumulative inflation, which would reach 100% in a period of 3 years. And that was already in 2018. So by the time we got to 2019, the situation had worsened. As you can see from the figures, just in a period of 9 months, we moved from around 59% to around 521%. So that projection, by the time we got into 2019, we then reached the 100% cumulative mark, which is required for a country to be put under hyperinflation or to be assessed as it has got a hyperinflationary economy. So that's part of the things that the PAB looked at. And then the other things that the PAB looked at as well was the requirements which come from the standard when you are assessing hyperinflation. So I'll take you to the requirements of IS 29, which is part of what they looked at. So the first requirement that they looked at is for a country to be placed under hyperinflation or for hyperinflation accounting to be applied, the general population normally prefers to keep their wealth in non-monetary assets or relatively in a stable currency. And by assessing the situation in Zimbabwe, I think everyone would agree that by the time we hit end of 2018, getting into 2019, everyone was at a point where if you receive your salary, straight away you go and convert it into US dollar. Entities were already budgeting in US dollars instead of the local currency which had been designated. So no one was really using the Zimbabwean dollar anymore for planning purposes or for holding wealth anymore. So that's the first thing that they looked at, and which ticked as an indicator to say we are already in hyperinflation. The second thing that they also looked at is an indicator which speaks generally to the general population regards monetary amounts, not in terms of local currency, but in terms of relative foreign currency. I think when you're looking at pricing, which was being done in commerce and industry, almost all entities were pegging their selling prices in US dollars instead of the RTGS. The RTGS only became a settling form of a currency, but in terms of your planning, your budgeting, your pegging of your prices, everything was being done in US dollar. So the second indicator was also ticking to the fact that the local currency that we were using has been hyperinflated. Then the third aspect that they also looked at is when you assess sales and purchases on credit, normally there is an interest rate which is attached when you're making your sales on credit. Now, in a hyperinflationary environment, that interest rate tends to go higher and higher and higher, more than the normal way it does in an economy which is stable. And when you look at the interest rates over the past 12 months, they've been skyrocketing almost on every month. Entities which were selling on credit, they have been adjusting their interest rates significantly to cater for that inflation. And that interest rate movement was not being caused by credit risk because people were able to pay, but it was catering for the loss of value which could happen over the period in which you're holding credit. Then I think if you remember, well, when you look at the overnight accommodation interest rate, it spiked to 50% at some point, which is just a sign or an indicator that people are trying to cushion themselves from loss of value coming from the currency deterioration. Then the last part that was also looked at was obviously the cumulative rate of inflation if it had reached the 100% mark within a period of 3 years. And like I pointed out earlier on, we didn't need to wait for 3 years, but actually we just had to wait for 3 months for that indicator to be ticked. So when the Public Accountants and Auditors Board looked at all these indicators and discussed them with the members, the other accounting boards which form membership with PAB, all of them came to a conclusion that we are sitting in a hyperinflationary environment. I think the biggest question was then, when exactly did we get into this hyperinflation? with most advocating for hyperinflation possibly started earlier on, probably in 2018, like what Ernest mentioned earlier on. We were not keeping track of these figures. So it is likely that we already had entered into hyperinflation by the time we got into end of 2018. I think the figures will show that before October 2018, inflation rates were always below 5% for 8 years. It had never been above 5%. At some point, we actually need deflation. But from October October 2018, getting into 2019, we started to see the inflation rate skyrocketing, going up into 100% and now into 600% as we speak today. Therefore, based on that, the PAB then issued out their guidance in terms of what needs to be done by all accountants. And they issued out that, that guidance on 11 October 2019. What they simply said was, effective from 1 July 2019, the economy of Zimbabwe was now in a hyperinflation environment, which means all the financial statements which were now being produced, if they were reporting for any periods which are after 1 July 2019, then they had to show two sets of financial statements, one being in historical cost and then the other one being adjusted for inflation using IAS 29. I think a good example of that would be the financial statements which Simbiso just showed you a few minutes ago, which showed the two financial statements. So that was the guidance which had been provided by the PAB. But other jurisdictions, especially around the region, like I said earlier on, if you were a subsidiary in Zimbabwe reporting or providing a financial statement to a parent company which is outside Zimbabwe, they had already started raising questions way before July 2019. So some had already placed Zimbabwe as hyperinflation, so they were already requesting their subsidiaries to apply IAS 29 way before 1 July 2019. Then from accountants' guidance, the Institute of Chartered Accountants Zimbabwe also gave their own guidance in terms of what needs to be done. They issued out their guidance on 20 November 2019, and I think the area that they were mainly focused on was what index do we then need to use in terms of adjusting those figures to reflect the inflation adjustment. And various ways of indexing were put on the table, but like Simpiso mentioned earlier on, reliability of that information is quite important. So the index that we come up with, it should be an index which is generally accepted by the people that are going to be using those financial statements. And I think the index that they simply then ended up agreeing on is the one that is normally recommended when you are hyperinflating, which is the CPI index. So that was the guidance which was given by ICAS in terms of how to actually do the adjustments. I'm sure that will come on in the next presentation that will be done. Okay. So that brings me to the end of my presentation in terms of what happened in terms of our regulatory environment. Back to you, Elliot. Thank you.
Webster, thank you very much for the insights in terms of the regulators as well as the financial reporting requirement that brought us to the need to report using IAS 29 hyperinflation. I've got a couple of questions from our attendees, which I'm going to direct to our panelists. The first one is going to Simbiso, where our attendee is asking, on a scale of 1 to 10, how has the inflation environment affected their reliance on the annual financial statements? So in other words, as investors, do you still make use of these financial statements in your decision-making processes?
Okay, thank you, with regards to the scaling, I can't say we then do not then rely on the financial statements. We do rely on them because they're the only source of information we have of the company. But it's about the assumptions which we then add onto that set of financials for them to be very meaningful. Obviously, we do not take them at face value. We then have to make other assumptions based on other fundamentals, which might not be in the same basket with the financial results, the financial statements as such. So the subjectivity of our assumptions then makes the relevance or the importance of those financial statements less intriguing. So I would say I'll give you a scale of the extent to which the financial statements have been affected by the ongoing environment. Whereas, let's say in a US dollar era, the financial statements were 100% reliable. Now, in an inflationary environment, they are 50% reliable. You have to make certain assumptions for you to come up with a near reliable recommendation or near accurate recommendation. Then the second question, sorry, it was about.
Okay, it was just one question, Simbiso. I think we'll address that one. Say, are you still relying on the inflation-adjusted AFS? So thank you very much. So what I picked out is, on their own, the financial statements are not enough. We have to look for other indicators of performance as part of the decision-making processes. Thank you, Simbiso.
Yes.
Then I put another question maybe for Webster or Ernest, which says, is it legal to just report in USD and to keep financial records in USD? This assumes the agents determine that the USD is their functional currency. In other words, our attendee here is, instead of cracking our heads trying to do this inflation-adjusted accounts, why can't I just report in USD, which is probably a stable currency?
Elliot, thank you so much for that question. That question is the biggest question, and I hope that under here we're also still going to get another discussion forum like this one to discuss this. So I would quickly say, when Zim dollar was promulgated, SI 33, SI 142, and SI 212, which said Zimbabwean dollar is the only, from a legal point of view, right? There is the legal, then there's the substance and IFRS position that functional currencies are assessed. So certain entities can actually assess functional currency and find them to be US dollars, right? But the reporting process, the reporting currency called presentation currency is a choice. It is a choice, unless probably there is a specific requirement that you shall report your financial statements in Zim dollars. So probably just to clarify again, functional currency is not a choice. So an entity can assess and actually find out that they are indeed using US dollar as their functional currency or Zim dollar. But on the reporting, it can be guided by them, or it can be a requirement, which is a choice eventually at the end to say which currency do I prepare my accounts on. However, the underlying documents or underlying records, accounting records, are recorded using the functional currency. So it is a very big debate, especially considering the SI 85, the one that introduced the US dollar free funds as settlement currency. That debate is a big one, and there is work going on right now to reassess the impact of all those. But that question is very valid. Thank you.
Okay, thank you, Ernest, for the insight. So effectively, Ernest is saying fractional currency is not necessarily a choice, but presentation currency, you can have leeway to decide on which reporting currency you are going to be using. Okay, thank you very much. So I know some of the questions that are being raised are around the value add of these hyperinflated accounts. Do they really matter? So to assist us in that discussion, I'm going to call upon Raymond Chamboko to share a bit, to say what value can you really derive from these inflation-adjusted accounts. And whilst Raymond is setting up, I'm going to run a poll just to get a sense from our audience on their thoughts around these hyperinflated accounts. If you can please participate in the poll that I'm broadcasting to your screens just now. Do you think they are of any importance? What's your take as our audience? Whilst Raymond is setting up, if you can please participate in the poll. Okay, I can see the results are starting to come in. So I'm going to give it a few more seconds before I publish the results of the poll. Because before I publish, I need to do some meticulous verification on the reliability of these results so that you don't question them as the hyperinflated accounts. Okay, for those who have not yet voted, if you can do so quickly, I'm ending the poll in 5 seconds. 5, 4, 3, 2, 1. So I'm going to broadcast the results from our poll. Okay, interesting. So almost 48% of our participants believe that it is one of the tools we use to determine if we are making any progress. So they feel it is important that we prepare these inflation-adjusted financial statements. 24% say if we do not have auditors, we will not bother preparing these accounts. And 17% say we have no interest in preparing IS29 adjusted financial statements. Okay, some interesting statements there. Raymond, over to you.
Good, right. Good morning. Good morning, everybody. Thank you, Elliot. Just to point out, Elliot, your countdown there was hyperinflated because those were not second. Much quicker than it should be. But all the same, let's carry on. So, why do we need to prepare inflation-adjusted financial statements, and what is the value add coming out of these financial statements that we're preparing when we do prepare them? I'm going to take us back a little bit to the conceptual framework. One of the things that we're required to comply with when we prepare a set of financial statements are two things, are the fundamental qualitative characteristics of financial statements. Are they providing relevant information? Are they faithfully representing what is going on within an organization? And do they reflect the cash flows, the financial performance, the balance sheet position? Forgive me, I'm old school, so balance sheet is still a word in my lexicon. But all these things, these two things need to be demonstrated in any set of financial statements that we present. And while we're at it, we also need to ensure that in applying these fundamental qualitative characteristics, we are able to prepare something that is comparable. I was having a look when I was preparing for this session to see whether or not I could compare, say, Ariston with what CFI are preparing in their financial statements. And to the extent that CFI use the historical cost basis of accounting and Ariston choose to use the revaluation basis for measuring their property, plant and equipment, it's going to be next to impossible to compare these two entities in any normal situation. Hyperinflation makes it worse because now if one company is preparing their financial statements based on cost and another has decided that they are going to inflation adjust their numbers, then you are going to have a vast gulf between these two entities in terms of the numbers that they're putting out. And that's just two companies that are in the same jurisdiction. Never mind when you now come to a scenario where you want to compare Econet against MTN. Two different currencies, one is in an environment that is hyperinflationary, the other is not. So in that scenario, how do you even determine whether or not this information is correct? And there's a verifiability. Can this information be verified? Simbisa made mention of the issue around the indices that are used, and whether or not it's the right index, the right basis for the index that is used. I'm not going to go down that path at this point in time, but I think the one thing that we assume is that whatever CPI numbers we are obtaining from ZimStats will be numbers that we are able to utilize without question. So therefore, that would then enable whatever numbers we've got in our financial statements to be verifiable. Another issue that Simbisa raised is the timeliness of preparation of this information. Now on this one, I've got a simple case in point to utilize as an example. My mom's business, she's got a December year end, and she just finished preparing her financial statements a couple of weeks ago. And in preparing a financial statement, she sent them to me to have a look at to see whether or not they make any sense. The one thing that I picked up though was the information that she had in the financial statements. She got and broken down everything by month, and she turned over more in December than she did for the 11 months preceding that, which makes no sense. So for me, timeliness of information is going to be important, because for the information to be of use to anybody, and now we're now 4 or 5 months later, 4 or 5 months after year end, for me to understand what the numbers mean in this environment, I must put on a hat of, well, what did the numbers mean in December? Do I remember that information? And can I compare that with the next person? And ultimately, is this information such that it is understandable? Do people understand what exactly it is that we're talking about? And the point that Simbisa made earlier on about the information that is being given, can analysts, can users, whoever the users may be, analysts included, can they understand exactly what it is that we're talking about as preparers of the financial statements? All of these things are things that are coming out of the, I went to one slide too far. Okay. So all of these things are, Elliot, do you mind taking me back 2 slides, please?
Okay, I'll just ask my tech guy to take control of the remote.
That's fine, thank you. That's where I wanted to be. So why are we restating? The point that I just made just now about the financial statements and comparability becomes quite important. It's necessary that whatever results are reported are not misleading. Whatever financial position reporting we do is not misleading. Hyperinflation by its nature is going to result in money losing its purchasing power, our inability to compare transactions that are occurring at different times. And at the same time, because an entity is trying to report information that it will be useful to the users, it must reflect in there the impact of holding on to assets or liabilities that might then have an impact on the accounting that is showing, that is reflecting in the financial statements that is presenting. And without any adjustment that is made to those numbers, it's going to be next to impossible to understand what those numbers truly mean. So when you look at the process of preparing the financial statements and what ultimately is reflected, there was a question that was raised earlier on. I guess Simbisa was asking the question from the point of view of trying to understand what is sitting in the financial statements. If you find yourself in a situation where you are holding on to more monetary assets than you've borrowed, than monetary liabilities that you've got on your balance sheet, that will ultimately result in you losing purchasing, in those assets losing their purchasing power, and will lead to a monetary loss. At the same time, if you find yourself in a situation where the inverse applies, you've got more liabilities than you've got monetary assets, that will result in a monetary gain. And in a hyperinflationary environment, it pays you to go and borrow more than it does for you to keep monetary assets on your balance sheet. Elliot made the comment earlier around, well, when you look at the numbers that are sitting on your balance sheet, what cash and so forth that you've got on your balance sheet, there's no point in keeping all those things on your balance sheet. You'll see when I talk about it a little bit later on, I'm going to come back to this point. But you'll find that in a hyperinflation environment, you would rather go and invest your money in something else. Keep your money, your wealth in a different type of asset, because you know that when the time comes you need to liquidate it, as long as it's an asset you can liquidate pretty quickly, then you'll be able to at least maintain the value of your asset. And in maintaining the value of your asset, it then enables you to then to keep your business going. So these are some of the things that we need to take into consideration in deciding, in determining what our accounting will then look like from a hyperinflation point of view. Webster? Elliot, sorry.
Okay, thank you, Raymond, for the insights around saying, why should we even worry about preparing hyperinflated accounts? And what stuck to my mind, the example you gave for your mom's accounts, December numbers, revenue performance, outperform 11 months of trading activities, which practically may not make any sense. So to that end, I've got a question from one of our audience or attendees who's asking, now that we have prepared these hyperinflated accounts, are we to pay income tax using historical or inflation-adjusted accounts? If Webster or Axon can assist on this one.
Okay, thanks, Elliot. So for tax purposes, if you really look at it, you're not going to be considering the inflation-adjusted amounts for paying your tax obligations, because if you look at it, ZIMRA is not really concerned about what your inflation-adjusted numbers are saying. They care about what you actually paid out or what you actually received in terms of the cash value at that date. That's
okay.
it for me.
Okay.
So you're basing it on historical. So basically basing it on historical numbers and not the inflation-adjusted numbers.
All right. So for tax return preparation, we make use of the historical financial statements. Maybe an interesting question for the taxman is, are they also not losing out by getting the taxes paid using historical financial statements? And I believe that's a debate for another day. And when we looking at my Q&A, I think one of the hottest topics which is coming out is the reliability of the CPI index, ETC. So to assist us in discussing the process that will be followed in the actual preparation of these hyperinflated accounts, I'm going to have Axon share with us a presentation on that area. And while Axon is preparing to set his presentation, I'm just going to run a poll, which asks the critical question to say, in preparing these hyperinflated accounts, which adjustment filter do you think is the most appropriate? And I'm using the word appropriate deliberately because there's no exact answer to this question. So I'm launching a poll, and if you can assist by participating and voting in this poll, which factor do you think reliably estimates the inflation in Zimbabwe? So I've got CPI, exchange rate, interbank, exchange rate, parallel markets, all the mutual implied rates. Yes, I can see voting has started. And like Raymond indicated in the previous polling, I'm not going to do an inflation-adjusted countdown. Okay, I can see I've got 70% of the participants who have voted. So I'm going to do another countdown. At least this time I'm going to go slowly. 5 seconds. So 5, 4, 3, 2, 1. We'll come to the end of our poll, and I'm going to publish the results from our polling. It appears 50% of our participants believe the parallel market exchange rates Okay, I'm just checking my sound. It appears 58% of our participants believe the parallel market exchange rate, correctly reflects the inflation factor, with 26% going for the odd mutual implied rate. Interesting results there. So I'm going to hand over to Axon to share more around the actual process of preparing the hyperinflated financial statements. Axon, over to you.
Elliot Jackson seems to have been disconnected, is getting on, is coming back.
Okay, thank you, Anisu. Maybe while you're waiting for Anisu, for Axon, Anisu, some thoughts on the interesting results we saw from the last report there. Our audience believe that we should be using the parallel exchange rate as the adjusting factor when we are preparing these hyperinflated accounts. Your thoughts whilst we're waiting for Axon?
Okay, so I'll actually address that, including some of the questions that I see on the Q&A. So the issue of the parallel exchange rate of the CPI, or they call it the general price index, which is required to calculate adjusting factors, has been one of the biggest debates since this story started. It started last year, if you remember, where the annual inflation information was said to be held back and only available after February 2020. Only the monthly was being provided, right? So it's a big issue on its own to say, can we use CPI in the absence of official statistical office data or information from the Central Statistics Office? The biggest debate on that is that we needed to go to the underlying changes in prices and say what exactly drives our changes in prices, and what drives the change in prices. We then use that as to calculate the factors. So I'm not surprised, and it's exactly what we had pointed out earlier from TARS, from our research and testings after doing a number of jobs, that the exchange rate was the better indicator for the price change in Zimbabwe. If you look at the CPI sitting at 500, 600 something now, versus an exchange rate that came from one, let's say officially it's at 25 now, that difference is huge in terms of impact on prices. But the actual prices are now being pegged at about 50, 45, 50, which is the parallel rate. So I do agree with the audience and the participants that suppose the results of the poll. Unfortunately, the process, Zimbabwe does not have many general price indices. You would expect other jurisdictions have got what they call producer price index. They've got your PPI, you've got your wholesaler price indices, and various that they also use. Unfortunately, the CPI talks to a household basket, not a corporate basket. And what drives it does not really link to what a business actually does. However, that's the one that we have in Zimbabwe. The exchange rate does also connect with the CPI to say where the CPI is not reliably there or not, the exchange rate can be used, and the standard on hyperinflation does indicate to that. So I think it's a big debate, which rightly so. And I think I also highlight when I look at the analysis to say, how do we separate some of those issues when you look at the numbers? I don't know if there's any other comments, Elliot, that you may want to come to.
Can I jump in for?
All right, Raymond, you can jump in.
I think that something else we need to take into consideration when looking at the appropriate index is that while CPI may be based on the household basket of goods, for a corporate, inflation for a corporate is not based purely on imported goods either. There will be elements in there of locally sourced goods which will be affected by local factors. So there's actually a need to have a blend. So if you look to the one, I think to the one which is based purely on exchange rates, whatever the parallel market is doing, then I think you're on the extreme end. Whereas on the other hand, if you look only to the household goods basket of goods, then you're on the the other end, the other extreme, which is the lower end of the possible inflation measure. Which one it is, I couldn't say, but in my mind, it looks like it lies somewhere in between these two measures. I think so. That's something that I think must be taken into consideration in determining what the appropriate CPI, the appropriate factor should be. But as we have heard, and I think it's legislated, if you are going to use a measure of CPI in the Zimbabwean context, then I think you also need to take into consideration that there's also the trying to keep within the laws of the land aspect to your reporting that must be considered. Thank you.
Okay, thank you, Raymond. So I can pick out that there's a huge debate around which one to go for, CPI, parallel market, or mutual implied rate. But at the moment, I'm going to hand over to Axon to go through the steps followed by preparers of actual drafting the inflation-adjusted financial statements. And I hope at the end of this presentation, the panelists will also come back in again, give us further contributions around this adjusting effect, because it appears that's the biggest sticking point around the inflation-adjusted accounts. Axon, over to you.
Thank you, Elliot. Good morning again, once again, everyone. So I'm just going to jump right into it. I'm going to highlight the steps that you are required to follow by International Accounting Standard 29, which is what we use to account for hyperinflation. So firstly, it requires that all items in your financial statements be stated in terms of the current measuring unit at reporting date. Effectively, I'm saying that you're supposed to measure every single item in your financial statements according to its current value. So if, for example, you find that in 2019, I could walk into a shop and buy a laptop for, say, let's say $1,000, and that's in February, $1,000. And then by the time I get to December, I'm now probably buying that same laptop for $10,000. When you're reporting at year end, you now need to compare these two, which is why you have to state that laptop that you bought in February in terms of the current unit at the end of the reporting period. Because you've got two laptops which are the same, one is recorded at 10,000, one is recorded at $1,000. That's why you're doing that restatement. And you're restating based on the movements in the general price index, which is what Raymond and Anis were discussing just now. I'll also cover it a bit in the following slides. And your restatement, the other part that determines how you're going to restate or revalue items in your financial statements, is whether, first of all, is it monetary or a non-monetary asset or liability, or is it measured in terms of current cost or its historical cost? That I'm also going to allude to in the slides that will follow. So for now, I want to discuss general price index. What is general price index? First of all, it's just the general level of prices of goods and services. And like Aniso alluded to earlier, in Zimbabwe, we only have CPI, and other countries have wholesaler price index, producer price index, and GDP deflator. So I think now I want to touch on what Raymond was saying earlier, that you can't then just consider the one. I actually think the same. You'd rather actually then have a blend. You're taking your producer price index, you're taking your GDP deflator, because now your GDP deflator is taking into consideration what is actually happening within the economy. And you've also got another one that's called employment cost index. But that one, I think only the United States has. So that one, I guess that then throws the debate wide open regarding the general price index issue. And also, again, like what Anesu said, your exchange rate, it's also a reflection of what's happening in the economy. But you now need to consider which exchange rate you're using. Because right now, I think the exchange rate has been locked at 25 Zim dollars to $1 for quite a while, the official exchange rate. But if you look at the parallel markets, there's something completely different. But then again, like what Raymond said, you're trying to stick to the laws of the land because you don't want to end up, is it a 10-year jail term? I'm not sure. I think it's a 10-year jail term for these funny things. Okay, so moving on from the general price index. There's something wrong with my slides, they're not moving. Okay, there we go. So when you're restating your statement of financial position, first of all, you're considering, is the item that I have measured at current cost or is it measured at historical cost? So at current cost, effectively, I'm saying that whatever it is measured at its current value at reporting date. So for example, you've got things like your fair valued assets and liabilities and your revalued property, plant and equipment. Those are examples of current cost items. And those ones at reporting date, you are not going to restate in accordance with IS 29 for the current year. However, the comparative figures, because they were current in the prior year, they're not current today anymore. You now need to restate those. And then your historical cost items, these are measured at cost, and since the item was acquired, it hasn't changed in value. So because it hasn't changed in value, in my books, and not on the market, of course. So in my books, for example, I buy a laptop for $1,000 in January 2019. By the time I get to December 2019, it's not worth $1,000 anymore. Just alluding to my example that I gave earlier of the laptop that's bought for $1,000 and then $10,000 at year end. So that one, you now need to restate from the date of acquisition. So that applies for current year and comparative numbers as well. And then your monetary items, you also need to segregate which ones are monetary, which ones are non-monetary. So monetary items are units of currency held and assets or liabilities to be received or paid in a fixed or determinable number of currency units. So what I'm saying is, I'll give another example. If you look at this phone of mine here, if I go onto the street, someone who's outside my door could probably buy it for $100 for me. But if I go maybe downtown, someone might offer me $80. So because I can't get a fixed number of currency units for this particular item here, it means that it is not a monetary item. It's a non-monetary item. So examples of monetary items are things such as your cash, of course, the cash that you're holding on hand, cash in your bank, receivables and payables. But you need to be careful with your receivables and payables, because you find that in your statement of financial position, people usually have trade and other receivables. And in other receivables, you have things such as prepayments. And prepayments are not monetary assets or liabilities, because if I go and pay in advance for, say, electricity, I do not have a right to receive cash. I have a right to receive a service, which makes it a non-monetary item. So that covers a restatement in your statement of financial position. And then now you've got a statement of profit or loss. In your statement of profit or loss, you're basically just supposed to restate everything based on the movements in general price index since the date of the transaction. So now I then get a couple of questions about that, about profit or loss, restating every single item. And I suppose the first question is, I've got 1,000 transactions every day across the country. I've got 1,000 transactions happening every day, 1,000 sales, 1,000 expenses that I'm paying for. And should I be going to each and every item every single day to restate? And the answer is no. You can, because you've already got your CPI for a month, it's not on a daily basis. You're just now going to restate based everything for, say, January 2019, based on the CPI movement from January 2019 to the end of the year. And then the second question is, instead of doing on a month-on-month adjustment of these profit or loss numbers, why can't we just use the average movement of CPI since the beginning of the year to the end of the year to adjust everything? The truth is, because of the environment that we're in, the inflation in Zimbabwe is very erratic. It can jump by, let's say, 50% in one month and 100% in another, or probably 10% in another month. Using an average won't give us a true reflection. I've actually done this test before. I've used an average and I've used month on month, and you see that the discrepancy there is quite huge. So you'd rather, in a state where the inflation increases erratically, you'd rather use the month on month instead of average. But in some cases, you might have hyperinflation increasing by 3% every month. Then I guess you can use your average for the year. Then moving on to equity. In your equity, you restate your share capital and your share premium from the date of authorization or issue of those particular shares in the statement of change in equity. you do not restate retained earnings. Retained earnings is derived from all other restatements. I don't want to say this, but it's effectively like a balancing figure in your statement of financial position when you're doing your hyperinflation accounting. And then you've got revaluation surplus. Your revaluation surplus, you also do not restate revaluation surplus. However, revaluation surplus that you had prior to hyperinflation starting is eliminated directly through retained earnings. And any other revaluations that you do after that, you maintain. And again, you're not going to restate revaluation surplus. And then moving on to statement of cash flows. As is with the general requirement for financial statements under hyperinflation, everything in the statement of cash flows is supposed to be reported in terms of the current monetary unit, or the current measuring unit, sorry. So you're going to take whatever adjustments you've done in the statement of financial position, your statement of profit or loss, you're now going to take them to your statement of cash flows. However, you're going to encounter difficulties making your statement of cash flow balance. The first thing is because you've got a monetary gain or loss, which Raymond alluded to earlier. And the second thing is when I'm looking at the movements of my cash flows, like for example, your receivables, your payables, my cash and cash equivalents, sorry, and my monetary items, your receivables, payables, and my actual cash balances. I'm comparing beginning of the year and end of year. There are movements that are there in between during the year, like movements that happened in February, movements that happened in March, movements that happened in October, where the CPI was different from what I had at year end and at beginning. That's one of the things that would throw it out of balance. So what you can actually do is to use month-on-month cash flow adjustments, just like what you do with a statement of profit or loss. So whatever cash movement that you've got in a month, you're also putting that you're also adjusting it by CPI for that particular month, or the movements in CPI for that particular month. That would then reduce how much your cash flow is going to be off by. But still, there's still some other difficulties that you will probably encounter in there. And I'll allude to it later on in the presentation. Then gain or loss on monetary position. I think Raymond has covered this, so I'm now going to just skip over that. You've also got complications surrounding application of IAS 29, particularly for Zimbabwe. So you find that in 2019, you had your SI 33, which was issued, which introduced the RTGS dollar, and all these other funny changes that happened with, regarding our currency. This then complicates the process because you've got, in 2018, you've got numbers that are being reported as US dollars. And then in 2019, you've all of a sudden got Zim dollars, and you're now trying to do an adjustment. And one of the questions that I've received is, 2018 I had US dollars, 2019 I have Zimbabwe dollars. What CPI should I use for 2018? And the truth is, if you really look at it, it was all Zim dollars back in 2018 anyway, even though it was being said to be US dollars, because very few of us could even get the cash. And then secondly, if you have not done your change in functional currency process properly, if you haven't carried it out properly, you will also have difficulties in applying your IAS 29. So you need to do your change in functional currency first before you do your IAS 29 adjustments. And then compliance, is compliance possible? I believe compliance is it's possible 100%, unlike with IAS 21 issues that we currently experience. This standard but then there's a lot of judgment that you then need to apply to certain things. For example, you've got things such as non-distributable reserves and change in functional currency reserves that we are sitting within our balance sheets, or in our statement of financial position rather. And those are not covered in the standards. In IAS 29, you don't find that they're under equity. You only have retained earnings and revaluation surplus mentioned. And then you've got, so the other thing is other jurisdictions. If you look at US GAAP, I think that's the major board set of standards that we could refer to. If you look at US GAAP, the approach is for subsidiaries. So I'll just give an example. Let's say I'm an American company and I've got a subsidiary that's in Zimbabwe. The moment that subsidiary enters into hyperinflation, the recommendation by US GAAP is that the subsidiary should actually switch its functional currency to the US dollar and actually start recording everything in US dollars on a day-to-day basis and report in US dollars, or report using the parent's functional currency, which is of course probably going to be the US dollar. However, this is an approach that could have been more reasonable. However, given that our exchange rate has been stagnant for the past 2 months, you are now going to be reporting funny numbers, because I'm sure prices in the economy have still been going up almost on a daily basis. So in the US GAAP approach then wouldn't work for an economy like ours, unfortunately. That's it from me. Thank you. Over to you, Elliot.
Okay, thank you very much, Axon, for the insights. And I can see my Q&A platform is on fire. People asking me more questions around what if, what not. So I've got a question which has been directly specified to Anesu. Would it be illegal for a company to publish USD results for FY 2019 or half year June 2020? Anesu.
Thank you, Elliot. Remember, like I said, the publishment of financial statements or presentation currency is a choice, unless probably from a regulation point of view, you're regulated, and you might want to also understand the requirements, the legal requirements of the regulator, and you might have to present that. But from IFRS, it is a choice that every entity has. But then if you bring the legal side of items, it's probably a presentation with your regulator of your position and why it is relevant. That makes a lot of sense.
Okay, thank you, Annie. So, for example, if I'm listed on the ZSE, the company generally need to check guidance from the ZSE on whether they are mandated to present Zimbabwe dollar financial statements, or they would leeway to publish United States dollar financial statements. Okay, I will move on to the next question, which Axon or Raymond can assist with. If I'm translating IS-29 numbers into another currency, for example, USD, how do I treat the net monetary adjustments in USD financial statements? So maybe I'm a subsidiary of a foreign entity, and my starting point is I prepared hyperinflated numbers. Now I want to translate them to my parent company's presentation currency. So there's an issue on how do I treat the net adjustments in USD financial statements. Raymond or Axon?
Okay, I think I can take that one. So from what I've seen happening in industry, you find that people, let's say the parent company doesn't have that particular line item for the net monetary adjustment in their presented financial statements. You could still include that line item, or you could put it as part of your other income or other expenses, because it's still part of your profit before tax. I don't know if Raymond has more to add to that.
Yeah.
Okay.
There are quite a few companies that I've come across in the South African environment that have got Zimbabwean subsidiaries. And what they've done is they basically take any monetary gain or loss position will then be converted into rand or into whatever other currency they're reporting in, and will be shown as such in their financial statements, depending on how material it is. If it's not material, it's then collapsed into another line item, as Axon indicated. But to the extent that it's a material number, then it will have its own pride of place on their income statement when they report.
Okay, thank you for that. I hope my attendee has been properly addressed. The other questions are around how do I restate foreign exchange losses in my income statement when preparing hyperinflation adjusted accounts? Don't know if Axon or Webster or Raymond can assist.
So please repeat the question.
How do I restate foreign exchange losses in my income statement? Hello, so I'm sure the attendee is saying in my historical financial statements, I've got a line item foreign exchange losses. When I prepare the inflation adjusted financial statements, how do I restate these exchange losses?
Okay. So if you look at the guidance that were given by IS 29 regarding treatment of items in the statement of profit or loss and other comprehensive income, you're supposed to restate based on the time that gain arose. So, but now the problem is some people then argue that this item, like the exchange gain and loss, it's not necessarily linked to what's happening with inflation. For example, right now, I won't be making any exchange gains or losses because my exchange rate has been locked, but my inflation keeps going up. So other people would rather then maintain the exchange gains and losses in terms of the historical amounts. So it's about, I guess it's about making a decision as management and also then agreeing with your auditors. If I think it's about agreeing between the two of you, management and auditors. It's a judgment issue. Thank you.
Okay, thank you very much.
Can I also come through there?
All right, see, hello, Webster can go, then Raymond can come after.
Yeah, thank you. I think we also need to be careful looking at the question which was raised prior to this one. We have got two exchange gains or losses that we're dealing with here. You have the one relating to where parent are reporting for subsidiaries, which is Zimbabwe, but it's a foreign parent. We have issues relating to translation from functional currency to presentation currency, and then which creates some exchange gains or losses, which are treated separately to the ones that we're talking about when you do your inflation adjustments, IS 29. So I think we just need to be careful in terms of how we treat those ones. One is relating to IS 21, if it's moving from functional to presentation, whilst the one which is relating to indexing is the one which relates to IS 29. Thank you.
All right, thank you, Webster. Raymond can also come in.
Webster said exactly what I was going to say. You need we've got two standards, so we need to be dealing with the appropriate standard. IS 21 matters, foreign currency transactions, those are recorded using IS 21. So therefore apply the requirements of IS 21, use the exchange rates that were ruling at the time that the transaction was undertaken. If there is then a movement because of inflation between that particular date when the transaction happened and your reporting date, that's an IS 29 matter. So apply IS 21 first as your starting point, and then the next step is then to apply IS 29 to it. You can't then say, well, foreign currency transaction, let me go and keep it in the foreign currency and translate it and not translate it for hyperinflation purposes at year end. The transaction happened at a date, at a point in time, so therefore the accounting for it must be at that point in time in terms of IS 21.
Okay, thank you, Raymond, for that clarification. So I'm going to move away from the Q&A platform for now and go over to the next presentation from Anesu on financial analysis of inflation-adjusted financial statements. So the key discussion here is going to be around making sense of these inflation. I'm sure I remember from Symposium's presentation where she indicated that as analysts, we are now a bit stuck on saying how then do we relate inflation-adjusted financial statements to the historical financial statements. Anesu, over to you.
Okay, I'm taking command of the slides. Thank you, Elliot. In this one, I'm just gonna highlight a number of things. The impact of inflation accounting on financial analysis. They changed the structure so that the users of these financial statements can understand where information is and why it is what it is, and the impact on normal ratios, as well as a few additional ratios that the analysts or any KPIs that the analysts may need to consider. Those are the few things. So I'll cover first the circumstance around the 2019 financial statements, then the impact on ratios and other qualitative considerations. Let's probably start with the circumstances. I'm sure a lot of these things we've already talked about. The effective date of change in functional currency. So when did the Zim dollar actually come out? When did we say this is Zim dollar? Is it 22 February? Is it earlier? Is it? So that's a very big issue, which does affect the numbers for which we need to. So the true date of function, inflation start date. So I would like to note, if anybody goes and study the inflation figures from I'm sure these days people are taking from RBZ website or inflation and central statistics office, what you find is that the inflation information starts from before 22 February, and on 22 February, it is killed on that day, and the new graph starts from there. If you remember, followed Webster, which starts from counting from then all the way, right? You have to compare inflation figures with a currency. That's exactly what this means. But that is now the biggest question, and saying, when did the true date of change in functional currency come through? So this from a government point of view, from an asset 33 point of view, currency changed on 22 February. So they killed the prior inflation figures that were said to be related to US dollars and started the Zim dollar. Whereas from the substance and everybody else on the ground, even on conversion, the inflation figures started popping up from July 2018. They started just skyrocketing and so forth. So that's a circumstance that one needs to note in terms of the figures that are being used. Then the conversion of the opening balances. So the opening balances were said to be US dollars and reported as such. How were these converted to Zim dollars? Right? Reliability of CPI, I'm not going to get deeper into that, but you needed to know, and you need to know when you're analyzing these figures. It's a very important circumstance that you need to consider. Then valuation. So what happened is a lot of preparers, when they tested CPI information, so you have got an asset that you bought, foreign asset you imported, and you bought it for 100,000, and you recorded 1 to 100,000. And you have still not paid the 100,000 US dollars by 2019. That 100,000 was being marked at the interbank rate, let's say of 18 by end of year. So you've got 1.8 million liability for an asset that's being recorded at 100,000. Okay, so if you then use CPI, which says it has only moved by 500 point something by year end, you couldn't compensate for that. Say my asset, I should restate it at the end of the year, 100,000 multiplied by 5, it comes to about 500,000. But the liability for the same asset is now sitting at 1.8, automatically causing insolvency in the financial statements, where the liabilities are higher than the asset. So many preparers then devoted for certain monetary assets, non-monetary assets like your land, your buildings, your property, to valuations, to try to value the intrinsic value of an asset in the Zim dollar terms at that point. Unfortunately, that didn't compensate enough still. Then the impact of legacy debts, like the US dollar value I was talking about, which is still being valued at the interbank, whereas the assets bought or the value that it brought in are valued at CPI. So that's a very interesting aspect. When you look at this situation, this statement under there has been the key denominator of the discussion, that financial statements are like fine perfume, to be sniffed but not swallowed. Okay. I'll then take you to the impact on the ratios. So when you're looking at ratios, I would like to emphasize again, ladies and gentlemen, I see from the Q&A questions coming through. Under a hyperinflationary environment, historical financial statements are misleading. Pack a bottle of water which was being bought for 25 cents or 50 cents is now sitting at about $6, if not 10. Now, when you come over a period and try to say, how have you done? You would see that there is a very big movement, but you have not taken into account the impact of inflation in those numbers. So what has happened, if you look at the financial statement, just to emphasize again, the inflation adjusted accounts are now the relevant accounts, but they are derived from historical. I have to emphasize that. And that's why you now see two sets for the statement of financial position, the balance sheet, the profit and loss account or the statement of comprehensive income, the cash flow, and the statement of change in equity. They're now being shown side by side, but the inflation adjusted has been promoted to be the most relevant in a hyperinflationary environment. So I'm trying to highlight which accounts should be analyzed and to be able to get relevant information. Let's go to comparatives. One also on the QA also was asking, how far back can I go? You can go as far back as information allows. So definitely comparative for 2018 needs to be restated. Now, the only problem that we have is the inflation figures for 31 December 2018 for those the December year ends, as well as the currency was misaligned at that point in time. So the availability of inflation figures is an issue. And that's why the guidance that came through says probably we need to play with the conversion that you have converted at a certain point in time, right? So comparatives, again, let's look at the issue on comparatives. We've got two comparatives. I think also pointing directly to what Simbiso raised, to say, I have got financial statements from comparatives. So first of all, you would find that your comparative figure of, forgetting the entity we're talking about, but the comparative figure there was stated at a certain date then. When we restate, we then say, let's bring that figure, if it has 10,000 in 2018, if I were to compare to today, 31 December 2019, how much would that 10,000 as of last year be? So that's how the comparative figures are restated. You are restating a figure of the past as if it were today, only affecting inflation, so that you can then compare 2019 and 2018. So the inflation adjustment heals the difference in time and the impact of inflation on figures. So very important to note that. Now, when you compare historical and inflation adjusted, exactly the same. In revenue figures have been happening throughout the period 2019 at 1:1, at 1:2.5, various rates and various prices throughout the year. But inflation then jumped very fast throughout the year to more than 500. So to then compare the figures in historical terms, what then, like Axon said, you then restate your figures that you use the best rate at, or the best factor being the 31 December, so that those figures are comparable. Just those are very important aspects to understand the figures that are being used. And as Axon also pointed out, you can also observe that certain amounts from historical to inflation adjusted are the same. Those are like investment property or financial assets in shares that have been measured at current values, and those are taken through. Your biggest problem in the current year is the impact of monetary items. So I'll take you through the impact of monetary items. So let's start with the P&L. In the P&L, you now have got a new item to say, I had, assuming, let's assume, ladies and gentlemen, that you had 10,000 at the beginning of the year in Zim dollars, and you still have that 10,000 at the end of the year. That 10,000 will not be buying the same things. So at the end of the year, we don't restate it. We keep it as 10,000. But at the beginning of the year, we restate it using an adjusting factor and say, this money, 10,000, if we had it today, what it could buy at the beginning of the year is more. Probably, let's talk about, it's now 22,000. But you are still holding it as 10,000. It means that you lost value of about 12,000. That's how that non-monetary gain or loss arises. On the assets, it is a loss because you're holding a receivable. That's the reason why you find that most credit has been terminated all of a sudden due to hyperinflation. Not many people are keen to give credit in Zim dollars because the more you hold monetary assets, the more you lose. But also on the contrary, you also find that loans are not easy to get for the same reasons. For one who is holding a loan, they're gaining. So that line is also appearing in all financial statements. Now, I would then expect from a financial analysis, over and above the other ratios, for one to gauge the ability of an entity to conserve and make value. The ratios like the non-monetary assets, assets over that, or let's say the non-monetary gain or loss over the bit there. Also looking at those non-monetary assets and how they're going to contribute to your profit, because those assets are the ones that are losing value over time. So your debtors, your cash are the biggest enemy on the balance sheet. The revenue mix is a very important aspect to understand as well. Some still have some foreign currency business versus the local business, and foreign currency business will definitely conserve value, while it's the local, especially on those, may actually have challenges. When you look at your gross profit margin, from the observation of most published accounts right now, your cost of sales seems to be so understated, mostly because if you don't watch out, is the method of measurement of closing stock, first in, first out, right? So it means your inventory is measured using the figures at the beginning of the year, which may not be properly restated. And what you find is, unfortunately, financial reporting does not allow LIFO, which is the last in, first out, where you would find that you measure your closing stock using the current prices, okay? So gross profit margin, watch out on it. The other biggest issue that affects our P&L was the suppressed employee cost. Employees have been the biggest funders of most businesses. They've been the biggest losers in the sense that the figures have been suppressed for a long time. So whilst you are looking at these profits or analyzing the P&L, the employment cost is a very important aspect to understand how it has been adjusted to be relevant. When you go to the statement of financial position, please look at the level of monetary assets. Like we said, this is where an entity is losing value. Your cash, your debtors, entities are losing value there. Versus liabilities, on liabilities and entities gaining. Because the more they hold other people's money, that money is losing value. That's why a lot of entities have been able to pay off their debts. That's why you see the non-performing loans have come down or almost come to zero, which was a big issue across the industry for mortgages. It's because people can now pay, and this is also has been seen before. Just a comparison between your monetary versus your non-monetary. And I think I'm just using these words because Axon has already defined what they are. The non-monetary assets keeps their value and they are remeasured as time goes. If I have a car and I could measure it in June last year, I can measure it now at the current price, so it keeps its value, whereas the monetary is fast losing. So we need to look at the change in monetary assets, how our data is being collected to quickly take our value back. It's a very important aspect. How are we collecting? Whilst one would say, I could conserve, I could keep a liability as much as legally and contractually possible, because there I'm keeping value, right? Watch out on foreign liabilities versus local liabilities. Your local liabilities has one bad problem. It's a good one from an inflation point of view, because whilst inflation is hitting, you can easily pay. But your foreign liabilities are being hit by that big change in exchange rate, which is moving fast. And that is a big issue on insolvency, on many financial statements. Lastly, the non-monetary gain or loss versus a non-monetary asset. Just to see that net from the P&L versus the monetary asset that you're holding in terms of its contribution to the overall financial statements. So those are critical items to look from the P&L. What we have also seen, and which is very relevant, is to say if the numbers, financial numbers, and some of these GP and so forth, they are affected. You'd see that the likes of Delta, if you look at the hospitality industries and so forth, they've stopped focusing much more on looking at progress or growth on the numbers because of inflation, because the prices look like you've made so much money, whereas in essence you haven't, right? So it's a very critical aspect that we include other non-financial KPIs like the change in sales volume. How many did we sell last year in terms of items, in terms of number, versus this year? Volume versus sales value. That can also help you to find a kind of like a weighted price across. But just to say, how are we doing? The percentage of foreign business versus local business. I'm also addressing here the investors. I'm wearing the head of investor and an analyst who says, can I invest in this business? What is its resilience? So definitely the local business, while it may be a challenge surviving from inflation, but if it can attract foreign currency, either local or foreign, it has got power to or ability to survive. Productivity and capacity levels. I'm sure the productivity levels, entities are now saying we are moving from 60% capacity or productivity to 30 to 40. All those are also key indicators. And I think analysts do take those into account. I also then thought of other qualitative considerations that one has to look at when they look at a business. Numbers, like we say, and very attractive perfume, but please don't swallow. You might need to consider other critical issues. Under inflation, not all businesses will survive or will go through the inflation window. Now, I would just also hasten to say, whilst we have inflation, we have added a very interesting aspect of COVID on top of that. So I'll park that there. When you look at inflation, you need to understand the price elasticity or sensitivity, the criticalness or essentialness of a product or service, to be able to reprice itself accordingly. Because certain prices are then regarded as luxury. While it's inflation and prices are going up, it's not easy for those products to be priced appropriately. And that is very critical, the issue of price elasticity. Use of local versus foreign suppliers. When you are analyzing, after looking at these financial statements, also look at that. This goes to say, while from a local supplier, you can actually get figures that don't necessarily have to chase the exchange rate being charged at a parallel, as it were, but you can also get local that are properly priced. So the burden on costs there. Ability to generate foreign currency, I've highlighted that one. Is the business now that SI 185 is out there, that the business can also receive free funds or else export. That is a very critical aspect to consider when you look at a business, including value preservation. A lot of businesses make cash. If a business is a cash cow, and
sorry to interject.
Hello?
I'm sorry to interject. We are not doing that well on time. If you may please wrap up.
Perfect. The value preservation, if a business is making cash and does not have ways to conserve that value, it will lose much. Look at the future fit of a business and the nature of industry and its resilience. The nature of industry is very important as well. So those are my few other additional factors. Elliot, I'm done. Thank you.
All right, Anesu, thank you very much. And for our attendees, our scheduled time to complete this webinar was 11 o'clock. So if you can please bear with us, we think we are going to spill over with about 50 minutes or so to allow us to have the last presentation done and also to take through some of your questions on the Q&A platform. So please bear with us on that one. So allow me now to introduce Raymond to take us through the last presentations, focusing on lessons from our past. So for some of us who know that we've been here before. So since we've been here before, what have we learned from that past and what can we do better this time around? Raymond, over to you.
Thank you, Elias. I have a poll. Can you put the poll up for a moment?
Okay, that's fine. Let me do so. So guys, these attendees, I'm putting up a poll where we want your feedback on your past experiences with hyperinflation. So the poll is now up. If you can assist by participating in the poll. And voting has started. And remember to press submit once you have voted so that at least your vote will be counted. And as per the rules of the voting process, one man, one vote. We are operating a democracy here. Okay, I can see the votes coming through. Yes, keep them coming. I'm sure you also my manifesto, so please vote for me. Okay, about to end our poll in 5 seconds. 5, 4, 3, 2, 1. This time around, I tried to make my counter not hyperinflated. So I'm going to publish the result from our polling. Raymond, I believe you can see the results from our poll, and 30% of our participants say we're still in primary school, secondary school, so don't have any prior scars from hyperinflation accounting and reporting.
No, good.
Raymond,
thank you.
Over to you.
All right, thank you, Elias. I can see that we have a pretty young audience in the room today, and the rest of us, and I think there's quite a few of us, I'm sure, who are on the call, who've been here before and have seen this and been there, done that. I don't know if that was me or if I've done something wrong here.
Okay. Have you been given control of the remote, Raymond?
It looks like it is. Okay.
Okay.
Sorry, it's just there's a bit of a delay in the response.
Okay.
Okay, there we go. All right. Thank you. Sorry about that. Okay, so we've been here before. That's the reality. I think if you look at the statistics that I've got in front of you, inflation back in 1999, we had inflation sitting at 120% already at that point, cumulatively over a 3-year period. So that was the first instance, first bout of hyperinflation that we had, which ran for a period of 7, 8, 10 years thereafter. because in 2008, we simply stopped trying to measure what inflation was sitting at. And I think at that point in time, we were in the quintillions, and we basically just gave up trying to measure it. But the reality of it, I think if we go back to what then happened is, we started preparing these financial statements that were hyperinflated in order to try and give us a sense as to what was the true value that was being reflected on people's balance sheets, and how those numbers that were being reported in people's financial statements should be understood. Back at the ranch, if you look at the commercial, what was happening in the background, Elliot, the slides are not moving for some reason.
All right, let me just Chipo, you can cross-check on the slides.
So if it doesn't mind just moving to the next one, I'm happy with that. So at that point in time, we'd started looking at, we look at the commercial aspects of it. Companies had started looking at different ways of dealing with this. Chipo, if you can go to the one that says preaching to the choir, thank you, that's that one. We started looking at alternative stores of wealth already. I used to work for a company back in Zimbabwe at the time. And one of the things that we did was that we had a warehouse full of motor vehicles. We had a warehouse full of inventory. That was the only way that you could store any value. And in storing that value, what you then did is that come the 20th of the month, you then went and you found a buyer for whatever asset you were looking to dispose of, whichever was most liquid at that point in time. And liquid in this scenario was basically whatever we could turn into cash as quickly as possible. And that's how we then paid our salaries, our wages. But basically what was happening at the time was that there was reviews of salaries and wages were happening multiple times a year initially. And it got to a point where it was starting to happen on a monthly basis, starting to happen on a weekly basis. And the payment intervals were also just as regular. You know, we moved away from monthly salary runs to literally weekly salary runs in order to enable people to have some value when they went to their bank. Then alternative payment methods were also initiated. Groceries, people being paid in groceries. Fuel coupons were a popular method of payment. Again, all of this was in anticipation of the fact that when you eventually got to a point where you could access whatever cash you had, you needed to be able to buy something with it. So while I may be preaching to the choir, some of you, those who lived through the time, for the rest of us who were not there, these were the things that we had to deal with. And in trying to deal with these things, what eventually transpired was the fact that we found ourselves in a situation where what was inflation, which became hyperinflation, very quickly then became severe hyperinflation. And I think at that point in time, that's when we then moved to 2009 then came, and there was the Zimbabwe dollar was done away with altogether. If you can go to the next slide, Chipo. I don't know if I can move, or you would like to move it for me. On the next slide, I'm basically talking about, so that's when the old mutual implied rate started. A lot of people were looking at what is our purchasing power parity? What is the number that we should be looking at? And when we're looking at financial statements, how should we understand it? Barter trading was the order of the day at the time, as was people pricing things in foreign currency, as is happening today, as we sit right now, where people, if you will pay me in Zimbabwe dollars, no problem, I will take it, but please know that my rate today happens to be 57. If the rate moves again next week, the rate might be 62. So all of this became the norm, and the intention being, as a trader in any commodity, I need to be in a position where whatever price I'm realizing from the sale of my assets should be able to enable me to replace that asset and generate a little bit of profit for me as well while we're at it. So unfortunately, what it then does is that it sort of becomes a self-fulfilling prophecy, because if I'm selling to you today and the rate happens to be 57, and I think that you'll pay me next week if I've given you a little bit of credit, then I'm going to price at a rate of 62 because I think that the rate might be there by the time we get to this time next week. Or alternatively, I could ask that, well, pay me in Zim dollars today that I've got access to the money today, or prepay me, because that's the only way that I'm guaranteed that I'll be able to make any at all. So the alternative performance measures came into play, which a lot of companies then started using. I mentioned the fact that, you know, we had warehouses full of inventory and that sort of thing in order to try and maintain that value. And in trying to maintain that value, Chip, if you don't mind going to the next slide, in trying to maintain that value, we find ourselves now, right now, in exactly the same situation. With statutory instrument 85 being brought into play and the legalization of trading in the foreign currency again, you'll find that a lot of companies are going to find themselves back in that scenario where they will look at situations and say, look, what currency am I doing the bulk of my trade in? I know these are some of the questions that have come in on the Q&A platform, where people are asking, well, can I prepare my financial statements in US dollars? If you're doing the bulk of your trade in US dollars, that is probably your functional currency. So if you go into and you did an assessment of your functional currency as you sit right now, what would that functional currency be? Remember, the one thing about preparing financial statements is that we've got those fundamental qualitative characteristics that we must comply with: relevance and faithful representation. I've got a few questions to ask, which I'll try and answer as well. Can investors understand what it is that we're telling them? We had Simbuso telling us right at the beginning that they look at these numbers, they take the numbers that we give them, apply a haircut or apply a further adjustments to them in order for them to be able to make sense of them. Well, we need to understand it. And to answer the question that she raised earlier on, is that when we prepare our financial statements in terms of IAS 29, I guess the one thing about CPI and all of that we've been debating this morning is, well, as to which one is the appropriate CPI to be using. If we are all using the same CPI, then we'll all be equally wrong if that CPI number is wrong. So when it comes to comparability, it won't be an issue trying to compare one Zimbabwean company against another Zimbabwean company, because we can see exactly where the numbers have gone and we've all applied the same incorrect factor. But I'm hoping here that we've got the right factor all the same. Then we've got the second issue. Who are we competing against in the capital markets? As a nation that's been starved of capital for a while, we are trying to attract as much capital as we possibly can. So in trying to attract this capital from the capital markets, international capital markets, what they're going to be asking of us is exactly this. Do we have a set of numbers that they can look at and understand? A set of numbers they can look at and say, well, these numbers are reliable. We can place reliance on without any qualms about them. And if we can't answer that question, certainly our historical numbers are not going to give us that answer, because again, going back to Anisu's example, a bottle of water that cost 25 cents 10 months ago now costs $10, 40 times the price in the space of in the space of a year. It's going to be next to impossible to understand what that means exactly. And the third question that I've got, do we offer a compelling proposition to attract new money? Do we still offer a compelling proposition to attract new money? I often say to people, there's been times that I've made my way to Harare, and in making my way to Harare, depending on what flight I catch, if I'm on the 6 o'clock flight, you will be assured that if I wanted to be on the 6 o'clock flight, 6 a.m. flight, you could be assured that if I didn't book that flight 2 weeks ahead of time, I wouldn't be able to get onto that flight, because there were that many people coming into Harare on a daily basis to try and see if, to scout for business opportunities. I don't know if the borders are opened again, that if I tried to jump onto an airplane to get into Harare on 6 o'clock flight, if I would be that hard pressed to get a seat at this point in time. Because you may find that investors are looking at the country and saying, you know what, we don't understand what these people are doing. So because we don't understand it, well, we'd rather not go there. Let's put our money somewhere else. So this may be, so the issuance of statutory instrument 85, like I said, maybe are one of the first steps to getting us back to some sort of sanity prevailing. The fact that we are allowed to trade in a currency that is the people understand. But at the same time, I understand the politics behind all of this, and the fact that as a country, we won't necessarily walk back the decisions that we've taken. But I think what we need to understand, what we need to do as an accounting profession is make sure that whatever information we're putting out there will enable that information to be relevant, to faithfully represent the position that we find ourselves in. And that basically means we need to apply IAS 29. Thank you. Yes, I think I'm done there.
Raymond, thank you very much for those insights. I'm sure, like you are correctly highlighting, it goes beyond just the reporting aspect. What does it mean for the business landscape in Zimbabwe going forward? Are we going to attract new money? Who are we competing against? Thank you very much. And to wrap up this session or webinar session, I'm going to go through a few Q&A questions that were raised in the platform. And I've got a number of my panelists that we have indicated that they want to respond to some of the questions that came through. So I'll start with Webster. If you can check the one on the US GAAP approach question.
Okay, thank you, Elliot. So I just wanted to point out that the reasons for going for the US GAAP is one which matters. When you look at the US GAAP, they were trying to resolve an issue of having financial statements from subsidiaries, which will come and fit into the financial statements of the parent, which is in the United States. So by going through with the functional currency of the US dollar, what it means is they have got an index which is actually put, which is basically all the financial statements which are coming through, they're being indexed and using an exchange rate of whatever the currency which is being used in the subsidiary country vis-a-vis the US dollar. So it's basically an indexing issue which is there. But when it comes to the functionality of how to do it, it's exactly the same thing which is happening in IAS 29. So you look at the US GAAP, it is adjusted. It's not the same way we do in IAS 21. So when you go back to IAS 21, if you adopt a functional currency of US dollar, what it means is that if you're transacting in ZWL, then you are transacting in a foreign currency. So by applying IAS 21, that means all the monetary elements which are there, they have to be translated using the exchange rate at reporting date. Whilst the non-monetary, they don't have to be translated, they remain at exchange rate at the date that we acquire control of it or we need the obligation to it, which is exactly the opposite of what we're trying to achieve in IAS 21, because the non-monetary are which are holding value. So they're ones which are supposed to be translated as we move to reflect the movement in value. Whilst the liability, the monetary ones, they stick to the value that they had, because if you owe someone, you're simply going to pay exactly what you owed. So the issue is not about how to do it, because the US GAAP simply says we are adopting the US dollar as functional currency for indexing purposes. But in terms of how it functions, it's exactly the same way with how it happens in IAS 29. Thank you.
Okay. Thank you very much for that response. Raymond, would you like to add something?
No, you can carry.
Okay, that's fine. Where say is it February 2019 that we are creating the change in functional currency reserve at the official exchange rate of 2.5? Axon?
Thank you, Elliot. I think that I'll then also answer the other thing that says, please enlighten me on how the change in functional currency arises. My understanding is that SI 33 stipulated that the conversion rate for assets and liabilities would be converted at par. What rate was applied? Can we say that was in contravention with SI 33? Okay, so to put these two questions together, the thing is when the change in functional currency happened, just to allude to what I was saying earlier, where you're buying assets at different values, but they're the same assets. When you now come to the change in functional currency or the date of change in functional currency, what others decided to do is to actually determine the US dollar value of the asset. So things, so that it actually then converted to Zim dollars using a proper value. And then that also resulted in certain assets not being restated at 1:1 or others being restated at 2.5, meaning that you had a balancing figure in your statement of financial position, which is where your change in functional currency reserve. So now the question of, is it February 2019? Not necessarily, but for most people, yes, it's February 2019. I've seen others applying October 2018. I've also seen others going as far back as 1 January 2018 or 1 January 2019 for their change in functional currency. And in terms of SA33 stipulated conversion rate, the thing is that the SA33 route is more of a complying with the legal aspect. And then you've got this route where you're actually applying a rate of 2.5 or whatever rate is available to you. Some were using a rate of 4 if they were converting in February. I think the rate was at about $1 to 4 at that time, the parallel market rate. That's where then that arises. So now the thing is, it was now a choice of a factor of management making a choice between complying with the legal, fully complying with the legal, or complying with IS 21. And in this case, they chose for their financial statements to then make sense, which is where the change in functional currency reserve comes from. That's all from me. I don't know if there's anyone else who wants to add something.
Axon, thank you. The panelists, anyone else to add on, or you are happy? Okay, there's no further contributions. I would want to express my gratitude and thanks to our panelists, Hane Sudaka, Webster Sigaoke, Axel Mafundemata, Raymond Chamboko, and Sipiso Musa, for taking time to share with us your perspective on this, on hyperinflation accounting, give this aspect, as well as Sipiso bring the perspective of the use of these financial statements, whether or not they make sense in where they are value add in the decision-making process. So ladies and gentlemen, it has been a pleasure being with you, and we hope you manage to get some practical insights into hyperinflation accounting, as well as the perspective of analysts and investors. And for those preparers who may require further assistance on any specific issues, our training and advisory team is available for a call to chat and see how best they can assist you. Post this webinar, we're going to be sharing you a link of the video as the presenter material that we use in today's session. And lastly, before we call it a day, if you can please complete the last poll that I have to assist us in coming up with the tailor-made webinars for you as the CA Business School, so that we can better meet your needs as you conduct your business activities. So I'm just going to give you a few seconds. If you can kindly participate in the last poll or vote. And on this one, there's going to be a prize for those who complete first. So my system shows me who completed first. And I'll be reaching out to your inbox to share a prize with you. Okay, I can see the votes coming through. Okay, we're just going to give it a few more seconds before we end the poll. Okay, I'll do my countdown. 5 seconds left. 5, 4, 3, 2, 1. And we'll come to the end of our poll. And as usual, I'm going to share the results of the poll. So the CI business team, I can see budgeting in a hyperinflationary environment is a key topic of interest to our audience to say, now we are in this mess, how best can we plan in projects going forward? Which is quite interesting. And I can also see investing on the ZSE coming through is quite an interesting item, 38%. And also integrated reporting. I'm sure integrated reporting, given that we just can't rely on the numbers alone, an integrated report might be able to give us more qualitative information around the business, around how the business is performing. So we are going to definitely make an effort to come back to you at the CA Business School with these topics and discuss these issues and see how best you can better proceed going forward in light of the issue that you have raised. So without further ado, I would want to once again thank you very much for taking your time from your busy schedules to join us in this webinar session. Should you require any further information from us at the CA Business School, please do take time to reach us on the contact details that are there on our screen. We've come to the end of our session.